Yeah, curious about the home. My son does, but all right. We are here for another Tuesday home finance hacks. Let's get this microphone up so you can actually hear me on this thing. All right, so when it comes to purchasing a home, a lot of people are under the idea that I need to get as much money from the seller as possible and I need to try to get the lowest interest rate possible and the best deal that I can negotiate on a house possible. And while that all may be true, there is one thing that a lot of people are not looking at. Yeah. It's working. All right, sorry about that. I was told my microphone wasn't working, but actually it is working though. So, in any case, let's get back to it. So, when it comes to purchasing a home, a lot of people are under the assumption that you need to get the lowest interest rate possible. You need to get as much money from the seller as possible, and you also need to get the best deal possible in a home. And while all of that might be true, one thing that a lot of people are not even paying attention to is something that actually could be the true game changer for you: spending more money. I know it sounds cliche. How is spending more money going to be the best deal for me? So, we're going to go into a couple things, two things really, that you're probably not paying attention to, but this is actually how some people that are wealthier, some people that play in the range of, multi-million dollar investment properties, apartment buildings. This is how a lot of them view purchasing and acquiring real estate as well. So typically a lot of people, when they're looking to purchase a home, particularly first time home buyers, what they want to do is they go in and they say, hey, you know what? I want to get the lowest interest rate possible. I want to finance as much as possible. So if I can finance 100%, let's finance 100%. Let's get everything financed. And that's going to end up with you getting the biggest mortgage payment that you could possibly get. But imagine what that would look like if, for example, you had a bigger down payment. I know a lot of people are like, I don't want to put money down on a home. Everybody wants something for nothing, essentially. But go with me for a minute. If you had a bigger down payment, so let's say the minimum is 3.5%, but rather than going that down payment assistance route and getting another loan to finance your down payment and everything, what if you saved your money and actually put more money down on the home? Essentially, what you would see happen is that would reduce your monthly mortgage payment. So it would do a couple things. One, it would reduce how much your mortgage payment is because you don't have as much financed that you're going to have to pay back. But the second thing that it will also do is it would reduce how much you're paying in interest over the life of that loan because you have a smaller loan amount. So you have a smaller loan amount, reduces how much you're paying in interest, but you also have that smaller mortgage payment, which reduces your burden that you have of all of this debt that you carry. So that's the first thing, is actually putting more into the home, more money into the, and the reason I say more money into actually the down payment, vice putting more money toward buying down your interest rate. And there are absolutely instances in which you want to put more money toward buying down your interest rate. But specifically with this, why I'm focusing on more money into the home is because that's the money that's actually going back to you. That's money that you're benefiting from. If you put money toward buying down your interest rate to get a lower interest rate, that will impact your monthly payment as well. But the money that you spend to get that lower interest rate is going to go to the lender. It's not going to be money that's going to come back to you in any form of equity. That money all goes to the lender and you benefit from the lower interest rate, which reduces your monthly payment. However, if you put that money into the home, that's money that can directly benefit you as well. So that's something that you really want to focus on, really want to pay attention to as well. So that's the one thing. But, and again, like I said, there are instances in which you do want to buy down that interest rate, particularly if the seller's paying for that buy down. That's an instance in which you really want to consider buying down that interest rate. But also there's some times where, you know what, the buy down might not be that much and it's advantageous for you to buy it down because maybe that buy down is going to pay for itself in the next 2 years or 18 months even. And it's like, hey, you know what, buy down that interest rate. It just makes sense. But right now we're just focusing on what you can do to actually put equity back in your pocket and reduce your monthly cost as well. And one of those things is putting more into the home up front in the form of that down payment. Financing 60% of a home, financing 70% of the home, financing 80% of the home will yield you a much lower down payment than financing 96.5% of the home, which is what most people finance when they get a traditional FHA loan, or financing 100% of the loan, which is what a lot of people do when they get down payment assistance on top of that FHA loan. So just something to think about. The second thing that I want to get into is putting more money, spending more money on debt. Now, a lot of people have debt. Obviously, life is expensive, but spending more money on debt, particularly if you have the money that you can put towards your debt, is something that can and will benefit you in the long run as well. I come across so many people as a loan officer who they have a lot of debt, and I let them know, hey, you want a particular purchase price, we're going to need to pay off some debt. So with the money that you have in your checking account, savings account, how about we take this money, we knock out this debt. I'm not going to take all of the money and knock out the debt, but I'm suggesting that we take some of it and we knock out this debt, and it ends up putting us in a position now where the amount of your monthly income that goes toward paying debt is drastically reduced. For example, if you got a car that you can knock out the payment on, or you can knock out the loan on, if you have the money to be able to knock out that car loan, maybe that frees up $500 more a month that you don't have to spend on a car note, plus, whatever you were actually going to give them in interest. So that frees you up to have more disposable income so that you can more quickly save up that money that you just put to pay off the debt. Same thing with credit cards. If you got a lot of credit card debt, if you're able to just knock out that credit card debt, that frees you up or puts you in a position rather to where you can now have less of your disposable income going toward paying 20% interest rates on those credit cards and making the credit card companies even more rich. And you're now able to more quickly save up your own money and position yourself better to be able to make some better financial moves. I see the same thing with personal loans. There are a lot of debts. If it's you have some buy now, pay later loans that a lot of people get as well. Amex cards, whatever it might be. If you're in a position where you're able to pay off a lot of debt, you want to strongly consider taking that route. And the thing is, because one, it's going to allow you to purchase a more expensive home. I'm not advocating that you need to go get a more expensive home, because maybe the lesser expensive home will work perfectly for you and what you need for a first time home buyer, or even as a second home buyer even. But what it will do is it will free up how much of your money goes toward paying out debt, because a lot of people are in debt up to their eyeballs and their check is spent before it even hits their bank account. They get their check and it's like water hitting the hot skillet. The money just flies away. And so you want to put yourself in a position where you can breathe a little bit easier, keep some of that money in the bank account without it all being spent before you even have a chance to look at it. So doing things such as reducing how much of your monthly income goes out toward debt is going to really help you in the long run with sleeping easier at nighttime, but also when it comes to qualifying more easily for that home and being able to qualify for a bigger and nicer home if that's what you need for you and your family. It's going to make it a lot more easier for you to be able to accomplish that as well. I want to take this from the standpoint of the wealthy, which is what I mentioned earlier at the start of this. So a lot of people who are wealthy and are purchasing investment properties and purchasing apartment buildings, apartment complexes, right now interest rates are high. And so when interest rates are high, monthly mortgage payments are high. What that tends to do when you're purchasing something in the multi-million-dollar range is a 0.25% difference makes a huge difference. When you're purchasing a $300,000 home or $400,000 home, that 0.25% might affect your monthly mortgage payment, a little bit. Maybe it affects it, $50, depending upon, the price of the home and everything. But when you get into that multi-million-dollar range, a 0.25% on that interest rate difference can mean thousands of dollars that is affecting you. And so when it comes to that, a lot of people who are wealthy and they're investing in these apartment buildings and everything, one of the things they do to continue to excel, to continue to purchase investment property, is that they're increasing how much they're putting down on the home. Rather than trying to finance these homes or these apartment buildings at 80% or 75% or whatever, they're putting more equity into the home. They're putting 35% down, 40% down, 50% into the apartment building. And that way, the amount that they have financed on this, higher than what you would like interest rate is a lot smaller, meaning that their monthly mortgage payment is a lot smaller. Well, now that they have a lot smaller monthly mortgage payment, the amount that they can make on the back end for rent and everything can be a lot more because they're not financing as much. There have been some people also who have been purchasing apartment buildings and they pay cash for the whole thing because that, in essence, they're not financing anything. So now everything that they make can be profit minus, obviously, the cost of, maintenance and upkeep and paying the management companies and everything like that. But as far as paying the debt on the property, which for a lot of people tends to be the biggest expense for real estate, is paying that debt on the property, it can be minimal. And so that's something that you really want to pay attention to, is making sure that you are, if at all possible, reducing that burden of the debt on the home. Now, this is not something that typically you hear a lot of loan officers talk about because we don't make money off of telling you to finance less. We make money off of you financing more. But I'm not speaking from a standpoint of trying to make money here. I'm speaking from a standpoint of trying to help you be wise with your spending and to think about something from a different vantage point when it comes to how you approach home buying, investing, finances in general. And the less debt you have, the more cash you have on hand, the better it is. And that's combined. Obviously, you're going to have to spend some of your cash on hand to pay the debt you owe. But imagine if you didn't have any debt, you were living debt free, you would be in a position to where now you can save up the money that you just spent so much more quickly if you're disciplined. That's the key. If you're disciplined, you can save up that money so much more quickly, if you will. $500 car payment, $150 in credit card debt, $300 a month in student loans, personal loan that you're paying another $175 on. You just add all of that up, you're in it for $700, $800 a month that you're spending in debt, maybe $1,200 that you're spending in debt. Maybe you have more debt than that. But if you were to get so aggressive with paying off that debt and then you stay disciplined with keeping it paid off, and you take the money that you would have normally been spending to pay that debt, you take that money and now you start putting in savings. Imagine going from $1,200 a month in debt that you had to pay from every single month's, paychecks, to now you're in a position to where you're saving $1,200 a month, or even, you take half of that in saving, you're saving $600 a month. So now you're in a position to where you're going to quickly be able to save several $1,000s. And you're in a much better position now to where you can now operate from a place of cash flow rather than a place of I make and then I hand over to the insurance company, I hand over to the mortgage company, I hand over to the credit card company, I hand over to whoever. You don't have to live that way. You can live a better way. And by doing that, and it sets you up in a position to where now when you go and purchase that home, you can take here's $20,000 that I want to put down on that home, and I'm going to reduce that mortgage payment. Or here's $40,000 that I want to put down on that home because we're not in a great mortgage environment right now, and I want to reduce that payment. Now, if mortgage rates get better, you've got some options there and everything. But this is just something, again, that I want to present to you so that you at least have a different vantage point where you can look at this thing through, because it might be your best option. So that's what I have for you. Thank you for taking the time to tune in. Make sure you tune in on Fridays, Greatest Asset Community Podcast, and then be right back here on Tuesday next week for another episode of Home Finance Hacks. Build 516. I haven't really been pushing this out because it's been getting built behind the scenes, but this is something that I want to mention is coming online. So what it is my resource center, if you will, where I'm really just going to be putting out some directional guides, if you will, that will be able to guide you into the area of better decision making when it comes to home ownership. So I'm going to be doing a lot of mortgage education, a lot of real estate education, because I am a licensed mortgage loan originator and I am a licensed real estate salesperson. So having the background of both of those, it puts me in a unique position to really be able to assist people and help them along their financial journey as it pertains to home ownership. And so I started up Build 516 or Build 516 so that I could really help people navigate home ownership, navigate credit, navigate where they are now to get them to where they are a home owner. So that's something that I just want to put the bug in your ear. It's going to be launched on a much bigger way in the near future, but the website is live now. But I haven't really been pushing it out yet. So if you're listening to this, you're among the first. Build516.com. I put out, there's a home buyer power hour that happens once a month. And it is some amazing, amazing information that is put out on that home buyer power hour call. It is literally 1 hour once a month. And I highly, highly recommend that you tune into the Home Buyer Power Hour, because by tuning into it, you're not only going to get all that information, you'll get access to the recording as well. But if you don't sign up for the Home Buyer Power Hour, you don't get invited to the Home Buyer Power Hour sessions, which it doesn't cost you anything anyways, but you also don't get the recording. So you want to make sure that you tune into that Home Buyer Power Hour so you can get all of that great information that's going to be put out. So that's what I have for you. Thank you for taking the time to tune in. Till next time, take care. Be blessed, and we'll see you next week.